Hello everyone, welcome back. Today we will be covering Chapter 2, which is the recording process. Let me see if I could pull up the presentation. Here it is. And let's start the slideshow. So let's begin by briefly reviewing what was covered in Chapter 1, which was the accounting in action. And the first objective that was covered was to identify the activities related to the accounting process, which were three. There were to identify an economic event, record the event, and communicate the event. Remember that there are two types of accounting users, including internal users such as managers and CEOs, and external users such as investors and creditors. The second objective was to explain the building blocks of accounting, ethics, principles, and assumptions. In terms of ethics, we covered the Sarbanes-Oxley Act. We saw a video in relation to that, and we learned about GAAP, which are generally accepted accounting principles. We learned about the Financial Accounting Standard Board and the Securities and Exchange Commission. And we also covered the historical cost principle, where you record the value of a property, for example, at the price that it was purchased, and the fair value principle, where the value recorded changes depending on the current value, which can fluctuate. Now, the two assumptions in accounting, remember that it is the monetary unit assumption, where you only record the transaction that relates to money, and the economic entity assumption, where the owner separates personal transactions from the business. This is the accounting equation that we will work with for the remainder of the semester. We cover the basic accounting equation, which is assets equals liabilities plus owner's equity, and the expanded equation, which is assets equals liabilities plus owner's capital minus owner's drawings plus revenues minus expenses. We analyzed transactions and recorded them in tabular form, just like you see here. And we did that by identifying at least two accounts that were affected by the transaction that we were analyzing, and by making sure that the ending balance were equal to each other, or they were equal to the based on the accounting equation equals which was assets equals liabilities plus owner's equity. The last objective I did not cover in last week's lecture. I will cover it today, which are the four financial statements. And we have four financial statements, which are income statement, owner's equity statement, balance sheet, and the statement of cash flows. In the income statement, as you see in this visual, it represents the revenues and the expenses for a specific period of time. So we have the revenues up here and the expenses. It is very straightforward, and it shows that the revenues for a specific month or a quarter. In this case, is for the month ended September 30th, 2017. The second piece of information is the list of expenses, which is right here. In this case, the list consists of salaries and wages, rent, advertising, and utilities. Then you sum up the expenses and you determine the net income, which is right down here, or the net loss. If you are making money after you pay your expenses, then you will have a net income, as in this case, which is $2,750. If not, then you will be reporting this as a net loss, and so this title, instead of net income, will be net loss, and then you would put the amount that you are reporting as net loss. Now, the owner's equity statement summarizes the changes in owner's equity for a specific period of time. Remember that owner's equity is what the owner can claim once all liabilities have been paid. So for this statement, which is also for the month ended September 30th, 2017. We report how much money was in the account on day 1. See, we have owner's capital on September 1st. There was $0 in the account. And then we add any investments. Remember that in your homework assignment, you added an investment because you were going to invest your own money into the business. This is what this represents, is $15,000. And then you add the net income from the income statement. And as you can see from this arrow, you see how the income statement relates to the owner's equity statement. You will just grab that net income or net loss and you will transfer it to this line. Then you subtract any drawings. Remember that an owner can draw money to pay himself or herself for the month to pay the, personal bills. And so these will be drawings that were made by the business owner to determine the owner's capital at the end of the month. So you would report them here. And so at the end of the month, you will see that the owner's capital is now $16,450 versus at the beginning of the month, which was 0. Now let me see if I can get out of here so I can show you this full picture, because it's not all there. It's gonna cut off. What happened here? Right here. I'm gonna try and blow this up. You see the balance sheet here. The balance sheet shows the assets, liabilities, and owner's equity in 2 categories. This is in relation to the basic accounting equation. And this is not for a specific period. In this case, it's for a specific date. It's for the day of September 30th, 2017. Now, the other 2 statements that we just talked about reported activity for a period for the month of September. And this could be a month of September, a particular month in the calendar year, or it could be a quarter statement. But just remember that for the balance sheet is based on a specific date. Now you report all of your accounts under assets. Remember, we've been working with 4 accounts so far: cash, accounts receivable, supplies, and equipment. So you report all of your balances there, and you add them all up to determine your total assets. Okay? Then you list the liabilities and owner's equity right here to determine that total. So you're going to put in your category liabilities and any accounts that are under there. You're going to see that right now we're working with accounts payable, and then all of your categories under owner's equity, which in this case is owner's capital. Okay, and you determine the total. And as you can see, it follows the accounting equation: assets equals liabilities plus owner's equity. So that will tell you that these 2 numbers need to be equal, okay? Now, they must be equal, otherwise something is wrong, okay? The last statement, and also too, you notice that owner's capital, you already determined that up in owner's equity, so that is in relation there. So every time you have to do a balance sheet and you have to draw in your owner's capital and you've done your owner's statement beforehand, just make sure you drop that value down here so you don't have to redetermine that. Now, the statement of cash flows is the last one. And this reports information about cash receipts or cash inflows and cash payments or cash outflows. This is reported in 3 categories, and you can see it here. You have the cash flows from operating activities, you have the cash flows from investing activities, and you have the cash flows from financing activities. And the goal of this document is to report the cash flow at the end of a period. In this case, it's also the month ended on September 30th, 2017. Okay, and you report that down here. So notice that all of these statements except the balance statement, the balance sheet, is the only one that reports for a specific period. The rest of them, for a specific date. The rest of them report on a specific period. Okay? And that is all we learned in chapter 1. Let's go back here. So you learn in chapter 1 how to analyze business transactions in terms of the accounting equation, and you learn to present the effects in tabular form. Okay, so let's go back. Now, the tabular format that you learn in chapter 1 is a basic way of recording accounting transactions, and can be a method that you can adopt if you have a small business. However, ask yourself this: what about if your business is growing and the number of transactions per day are in the hundreds or even thousands? Do you think that the tabular form will be a method that will be practical for you to follow on a daily basis? Well, if you were in person, I hope you will say no, because this method is very time consuming. So in this chapter, chapter 2, we'll introduce you to the recording process, which streamlines the tracking of transaction data. In chapter 1, you learn that there are several accounts within the parts of the accounting equation. Remember, for example, assets, you had the cash, you had the supplies, you had the equipment. All those were accounts within the accounting equation. So here we review what is an account. An account is an individual accounting record of increases or decreases in a specific asset, liability, or owner's equity. And an account consists of 3 parts, as the visual shows here. You have the title, you have a left or debit side, and the right or credit side. We refer to this illustration as the T account, simply because the format resembles a T right here. You see this T. Now, you ask yourself, what are debits and what are credits? Well, many of you may think of a debit as a minus, a decrease, or a negative number, while a credit is a plus, an increase, or a positive number. This concept seems logical when dealing with your checking or savings account, but this is not the case in accounting. Debit does not mean decrease, and credit does not mean increase. Okay? As you can see from this visual, debits and credits both increase and decrease depending on which account you are dealing with. Notice that here, assets, if you want to increase, it's a debit, and if you want to decrease, it's a credit. But in liabilities, if you want to decrease a liability, it's a debit, and if you want to increase a liability, it's a credit. Notice that it's different for the rest of the accounts too. So what is the point of this? I need you to erase that debit means negative and credit means positive. I need you to erase that from your brain and only remember that debit is the left side and the credit is the right side of the account. That is it. Debit is left, credit is right. Left for debit, right for credit. Now also please note that debit is abbreviated as DR and credit is abbreviated as CR. Okay? Now to show you visually and relate this concept with the tabular form that you learned in chapter 1, let's look at this visual. I brought back the rules for debit and credits on the accounting equation. That's just for you to visualize this, but let's focus on this visual down here. One of your asset accounts is cash, correct? If you remember from your homework, you invested some money to open a business. In this visual, it shows an investment of $15,000 in cash. Okay? Now look at your debit credit rules under assets, because cash is part of assets. When you want to increase the cash account, you do so by debiting. You see that there's a plus sign under the debit. You increase the cash account by debiting the T account. So translating this information from tabular form to the accounting form, we document this $15,000 on the left side of the T account, or a debit. Notice that your debit and credit rules show this T account for assets, and this is the T account for cash. You want to increase money, you debit it. You want to decrease money, you credit. Okay. Now let's say that this $7,000, you notice it's a minus. It represents $7,000 worth of equipment that you purchased in cash. This means that your cash account was decreased by $7,000, correct? Looking into the debit and credit rules for assets, when you decrease the cash account, you credit the T account. You see that? So translating this information from tabular form to account form, we document the $7,000 on the right side of the T account, or the credit side. Okay? Similarly, we continue this process depending if the cash is withdrawn or deposited into the account. You see all these here represents you deposited $15,000, you minus $7,000, you deposited $1,200, you deposited $1,500, and then you minus $1,700. And all that is going to be recorded on the T account for cash as it either debit or credit, depending if it's increasing the account or decreasing the account. Okay, now notice that we have a balance of $8,050. After all of these transactions are recorded, we have a positive balance for cash, right? Or if this is an asset in general, we say that we have a debit balance. Okay, debit balance, because it's a positive number, so it's on the debit side. A credit balance is when the credit amounts exceeds the debits. Okay. Alright, so now the visual for debit and credit rules will be your best friend for this semester. Until you memorize this chart, I suggest that you keep this visual close to you when completing your homework. And before you know it, the information on this chart will become second nature to you. But until then, just follow the rules and you will do just fine with the homework assignments. Okay, now notice under liabilities that the rules are opposite from assets. Remember that liabilities are your credit cards or your bank loans. When you charge a debt on your credit card balance increases, correct? So, well, when you record this transaction, you are giving a credit to your liability. Notice that in order to increase a balance on your liabilities, you have to credit that. Okay? And when you decide to make a payment on your credit card, your balance will decrease, right? Usually your statement comes in that you made a payment, and so your balance is now lower. Well, in order to decrease your liability, you need to debit. You see how there's a minus here. Also, notice that the rules change for owner's equity. You see these? All these are for owner's equity. Depending on the account that you are working on, will depend if you debit or credit, and it will depend if you want to increase or decrease your account. Okay. We already covered that, so let's go into what's next in the accounting recording process. Another step in the accounting recording process is journalizing. Keeping a journal is what most people use in the recording process. It is referred to as the book of original entry. And give me 1 second here, I have the phone ringing. So, continuing with the lecture, the next step in the accounting recording process is journalizing. Keeping a journal is what most people use in the recording process, and as I said earlier, It is
keeping a journal
as
is
the
what
book of
most people
original
use in the
entry,
reporting process,
and the journal shows the debit and the credit effects on specific
original
accounts.
entry.
So the journal makes the following
debit and the
contributions
credit
to the
effects on
reporting
specific
process.
accounts.
It discloses in
the journal
one
makes
place
the following
complete effects
contributions
of a
to the reporting
transaction.
process.
It provides
It
a chronological
in one
record of
place the complete
transactions,
effects of a transaction,
and it helps prevent or locate
it provides
errors
a chronological
because
record
the
of
debit and the
transactions,
credit amounts for each
and it
entry
helps
can
prevent or
easily
locate
compared.
errors
Because the debit and the credit amounts for each
And
entry
so
can
let me put this
easily
into
compared.
slideshow.
Okay, and
So
this
let me
visual
put this
shows a
into
complete
slideshow.
journal entry. Just as down here.
This
You have
visual
the date
shows a complete journal
of the
entry.
transaction.
Just as
The
down
account
here.
titles.
You have the
and
date
the amounts of the transaction
to be debited,
the account
and
titles,
credited.
and the amounts. And one thing you notice is that the first line is not indented. This is the first transaction.
And one
here.
thing you notice
For
is
equipment.
that the first line is not indented,
but the second
first
line
transaction
is
here.
indented
For
the line for
equipment.
cash. But
when you journalize, you will always enter the
line
debit
for cash
first.
Remember, you will determine
When you journalize, you will always enter the debit
first.
dealing with.
Remember,
If it's a debit
you
or
will
credit.
determine where
Every time you journalize,
depending on the
which
first
account
line
you're
should
dealing
be,
with, if it's a debit or a credit.
every time you journalize,
you are
the first line should
debiting
be
first,
which is not indented,
and
the
the
second line will always be the
debiting
credit
first,
the credit
which is not indented,
and the second
the
line
credit
will
line,
always be the
which
credit
is
which is indented. Okay, the credit line
After each
which
transaction,
which is indented.
you would add a brief
Okay?
description,
which is right here in parentheses.
After each transaction,
and
you
this
would add a brief
explanation
description,
will include
which is
clear
right here in
information that will
parentheses.
inform the accountant what the transaction
And this brief
was for.
explanation will include
Then,
a
of
clear
course, information that will inform the
you have the
accountant what the
debit and
transaction
the
was
credit
for.
columns.
Then, of
So,
course,
in summary, the journal is a
you have
place
the
to
debit and
record
the
all
credit
transactions
columns.
in the business.
So,
in
in summary, the
chronological
journal
order.
is a place to record all transactions in the business.
Now,
in
from the general
chronological
journal,
order.
this is the general
Okay.
journal.
Another
from the
visual.
general journal,
This is for September 1st.
the
and
general
notice
journal.
that there's a debit for cash
Another
first,
visual.
and then
This
credit
is,
for owner's
September
capital.
1st,
You know
and
that it's a
notice
credit.
that there's a
because it's
debit
for
indented.
cash first, and then credit for owner's
from
capital.
the general
and you know that
journal,
it's a credit because
we then
it's
transfer
indented.
the journal entries to the ledger accounts.
From
the
these
general
bottom
journal,
ones are the
we
ledger
then
accounts.
transfer the journal entries
This
to
is
the
called
ledger accounts.
posting.
And these bottom ones are
And
the
this
ledger
visual
accounts.
clearly show how to transfer
This is
a
called
general
posting
entry to the ledger.
And this visual
Basically,
clearly
what you are
show
doing
how
is
to transfer a
separating
general entry to the ledger.
transactions.
Basically,
And
what you are
posting them
doing is
in the
separating
appropriate account, whether
the
it's cash or
transactions
liability.
and posting
in this
them
case, it's
in
cash
the
and owner's
appropriate
capital.
account.
Whether it's cash or liability.
Okay.
In this case,
One
it's cash
extra
and owner's
component of the
capital.
ledger is a column for balance.
Okay.
One extra
Okay.
component of the ledger is
And
a
basically,
column
what you're
for
going to be
balance.
doing is for each line that
Okay.
you post here in the ledger, you're going to find
And
what that
basically,
balance
what you're going to be
is.
doing is for each line,
Whether it's
that
adding
you post
cash
here
into
in the
your
ledger,
account,
you're
you're going to find what that balance is. Whether
If you're going
it's
to be
adding cash into your
deleting
account,
money from
you
your
put
or
what
taking
that
out cash from your
balance
account, then you're
is.
going to put it
If
in
you're
as a
going to
credit.
be
And
deleting money from
then
your
your new
taking out
balance is
cash
going
from
to
your
be
account, then you're going to
13,000.
put it in as a credit.
so on.
And let's say it's 2,000,
Okay.
then your new balance is going to be
So let's put all this
13,000.
information into
And so on.
perspective.
Okay.
So let's put all this information
From this
into
visual,
perspective.
we can see what we learned in Chapter 1. We have a description of a transaction
from this visual,
that
we
needs
can
to
see
be
what we
recorded.
learned in
It says
Chapter
that
1.
the asset
We have a
cash
description
increases
of a transaction
$10,000
that needs to be
owner's
recorded.
equity.
It says that the asset
Here's a transaction.
increases
Reading the
$10,000
basic
in
analysis.
owner's equity.
On October 1st,
Here's
this
a
company
transaction.
invests $10,000
Reading
in
the basic
cash
analysis.
in an
On October
advertisement
1st,
company called Pioneer
this company invests
Advertising.
$10,000
So that's
in
our
cash
transaction that we
in an advertisement company
they
called
give us a
Pioneer
description for.
Advertising.
Then
So
we
that's our
analyze the
transaction
transaction
that
to
we,
determine which two accounts are
they give us a
affected. Remember,
description
we need
for.
to affect
Then
at
we
least two
analyze the
accounts.
transaction to determine
In this
which
case,
two
it's
accounts are
determined that the
affected.
cash
Remember,
is
we need
increased by
to affect at
$10,000
least
and
two
owner's
accounts.
equity
In
is
this
increased
case,
by
it's
$10,000.
determined that the cash is increased by $10,000
Okay.
and owner's
When
equity
we then record
is
these
increased by
transactions in
$10,000.
tabular form, and you did that in Chapter 1.
Okay.
With the
When
Excel
we
sheet.
then record these transactions in tabular
Okay.
form, and you did that
And
in
it's in
Chapter 1
reference to the accounting
with the
equation.
Excel sheet.
Remember, was cash is under assets and
Okay.
owner's capital is under
And it's in
owner's
reference
equity.
to the accounting equation.
Remember, was
Now the
cash is
next
under
step
assets and owner's capital is under owner's
is
equity.
to complete the debit credit analysis.
Now the next step,
by following the debit credit
is
rules to complete the debit credit analysis.
Once that is determined,
by
you
following
journalize
the
the
debit credit
transaction.
rules. Here's a journal.
Okay. Once that is determined, you
And lastly,
journalize
you
the
will post it in
transaction.
the ledger with the corresponding
journal.
accounts. Okay?
And lastly, you will post it in the ledger with the corresponding
this whole
accounts.
entire chapter.
Okay?
That's basically
This
what
visual
you're going to be
shows you
doing
what the
this whole
general
entire
journal looks
chapter.
like. Think of this as your checking account
This
statement.
visual shows you what the general journal
that you
looks
receive
like.
every month.
The
Think of
statement
this as
for
your checking
your
account
checking
statement.
account
Records
that you
all
receive
of the
every
transactions
month.
you
The
made within the
statement
month.
for
Correct?
your checking
You
account
paid bills, you
records
deposited money,
all of the transactions you made within the
you
month.
took out
correct?
money, you
Same
paid bills,
concept
you
here,
deposited
except
money,
you record the accounts
you
that
took
you
out money
are
that are
same
affected by
concept
the
here,
transactions,
except you record
and
the
you
accounts
determine
that
if
you
there
are
going to be
that are
debits or
affected by the
credits according to
transactions,
the debit credit
and you
rules.
determine if
So in
there
this
are
case, it
going
shows
to
that
be debits
on
or
April
credits
1st,
according to the debit
supplies
credit
were
rules.
purchased for
So in this case, it
$5,000.
shows that on April
accounts
1st,
payable
supplies
will tell you
were
that you paid
purchased
it
using
for
a credit card on
$5,000.
account.
And so this
Accounts
transaction
payable
here will tell you
say
that you
that
paid it
it's
for
using a credit
buying
card on
supplies on
account.
account. So this transaction here,
Okay.
you say that it's for buying supplies
Now,
on account.
okay.
And then on April 30th, you decided to pay the credit card balance by $3,000.
And then on April 30th,
you decided to pay the credit card balance by $3,000. So you paid it in cash. $3,000. So
this is
credit
the two accounts
cash
that are affected. You
for
debit
$3,000.
accounts payable for
And that's to pay
$3,000,
charges
and
on account. And you continue that with the
cash
journal.
Every time that
for
there's a
$3,000.
transaction, you
And
record
that's
it
to pay
in one
charges on
journal
account.
in
And you continue that with the
chronological order.
journal.
Remember.
Every time that there's a transaction, you record it
Okay.
in one journal.
Now this visual shows you what a general ledger looks like.
Let's go back to the checking account
Now
statement.
this visual shows you what
Pretend
a general
that you would
ledger
like
looks
to
like.
know how you
Let's go
spent
back
your
to the
money on a
checking account
particular
statement.
month. Pretend
You
that
want
you
to know
would
how
like
much
to
money you
know
spent on food,
how you spent your money on a
gas,
particular
how much
month.
you spent on clothes, etc.
You want to know how much money you spent on
think
food,
of the
how
general
much you
journal
spent on
as
gas,
the
how much you
statement that
spent on
separates
clothes,
the
etc.
transactions based on each account.
Well, think of the general
within the
journal
accounting
as the
equation.
statement that separates
So you're
the
going to
transactions
separate
based on
all
each
the stuff
account
that you have here
within
in the
the
general
accounting
journal
equation
by accounts.
So you're going to separate all
you're
the
going to
stuff
have
that
your
you have
supplies
here in the
accounts, your
general
accounts
journal
payable,
by
and your
accounts.
cash.
And any transaction that
You're going to have your supplies accounts, your accounts payable, and your
accounts,
cash.
you will
And
separate it in the
any
ledger
transaction
according
that
to the
affects each
date
of these
in chronological order. Accounts, you will separate it in the ledger according to the date in chronological
Along with this
order.
information, you have to have a balance column, which states the balance
Along with
of
this
each
information,
account
you
after
have
each
to have a
transaction.
balance
So
column
here,
which
on
states
April
the
1st, you
balance of
charge
each
supplies
account
on
after
your
each
credit card.
transaction. So you
Okay,
credited
so
in
in
$5,000. Your
on
balance
April
was
1st, you charged
$5,000 on
supplies
April
on your
1st.
credit card.
But on April 30th,
So you
you decided to make
$5,000.
a payment
Your
to the
balance was
account
$5,000
on April 1st.
for $3,000.
But on April 30th, you
So you
decided
debited
to make
$3,000.
a
So now
payment
your
to
new
the
balance
account
on that account is
for
$2,000.
$3,000.
This is what the $2,000
So you
represents.
debited $3,000. So now your new balance on that account is $2,000, and this is what the $2,000 represents. So how do you know if you recorded everything correctly? One way to check is by completing a trial balance. This is what a trial balance looks like. One way to check is by completing a trial balance. This is a list of accounts with the balances. And basically, what this is a list of accounts over in your general ledger. With the balances, you see how you have that you have determined over in your general ledger. You see how your accounts payable is $2,000 and your supplies account $5,000. All you do is your accounts payable to your $2,000 and your cash is $7,000. All you do is basically what this is a list of accounts with the balances. And the balances will be recorded on either the debit or the credit side with the balances, depending if there's a debit will be recorded on either the debit or the credit side. Remember that a debit balance is when the total of debits. Remember that a debit balance the total of debit amounts exceed the credits, and likewise a credit balance is when the total of debit amounts exceed the credits, and likewise a credit balance is when the credit amounts exceed the debits. Is to list each account. So what you do with the balance on either the debit is to list or the credit side each account, and then find the totals for each column. With the balance on either the debit or the credit side is done, and then find the totals for each column. The debit, you will know that column is everything equal to the credit column correctly. But just please note that the trial balance is only equal to the credit column. And there will be instances where the debit trial balance is only side and the credit side, and there will be instances where the debit incorrect side and the credit side will equal. This may happen if a transaction is not journalized, or when a correct journal entry is not posted. This may happen if a transaction is not journalized twice, or when a correct journal entry is not posted, incorrect amounts or when a journal entry is posted twice, or when incorrect amounts are posted.
So, continuing
now, the last
with the
part
lecture,
of this lecture would be to complete your homework assignments.
And in order for you to know what to do, I'm going to provide you with a little
accounting
example.
recording process is journalizing. Keeping a
To
journal
help you
is
visualize
most
what
people
you
use in
need
the
to complete for
recording
your homework
process, and
assignment
as I
this
said
week.
earlier, it is referred to as the book of original entry. And the journal shows the debit and the credit effects on specific accounts.
Let's use this example
the journal
here.
makes the following contributions to the
This is
recording
Renato's
process.
travel agency.
It discloses in one
And
place the
basically,
complete effects of a transaction.
it's going to bring you back to
It
the
provides
homework
a
assignment that
chronological
you
record of
completed for Chapter
transactions,
1.
and it helps
We
prevent
have
or
a
locate
transaction here that
errors
says,
because
on
the
April
debit and the
1st,
credit
Renato
amounts for each
paid
entry can be
$5,000
easily
for supplies
compared.
in account.
Okay.
So if you remember
put this in the slideshow.
from your first assignment, from your first chapter,
This visual shows
you needed to
complete
analyze
journal
which accounts
entry.
are
Just
affected by this
down
transaction.
here. You have
And
the
you need
date
to remember that you
of
need
the
to affect at
transaction,
least two
the account
accounts.
titles, and the amount.
In this case, when you
to be
are
debited
buying supplies on
and
account,
credited. And what you notice is that the first line
supplies is going to be a
indented.
keyword
This is the first transaction here.
that is under
for
assets.
Equipment.
And on account
But the
means that you are
second
paying it
line
with
is
a credit
indented.
card,
The line for
so
cash.
it's a liability.
When
So,
you journalize, you will always enter the
you're going to be
debit
dealing with the
first.
assets
Remember, you will
and
determine
the liabilities.
which one.
And then
depending
now
on
you
which
need to
account
ask
you're
yourself,
dealing with, if
okay,
it's a debit or a credit. Every
supplies
time you
is
journalize,
going
the
to
first
be
line
in
should
under my
be,
assets, and is this purchase for
what you
$5,000 going
are,
to increase
debiting
or
first,
decrease my
which
account
is not indented,
for supplies
and
in
the
assets?
second line will always be the
Well,
credit.
you're buying
the credit,
$5,000 of supplies, so that's going to
the credit
increase your
line,
assets.
which is indented.
And if you look under the assets rules,
after each transaction,
in order to
you would
increase
add
the
a brief
account,
description,
you
which
need
is
to
right here
debit.
in parentheses.
This is the
And
reason
this
why I
brief
put here that
will include clear information that will inform the
you need to
accountant
increase
what the
supplies
transaction was
or
for.
debit for $5,000 since this is an
You
asset.
have the debit and the credit columns.
Now the other part of this
in summary,
transaction
the journal
is
a place to record
you're going to charge
all
it to your credit
transactions
card,
in the
so
business
it's
in
going to be
chronological order.
under accounts payable,
Okay.
which is part of your
Now
liabilities.
from the general journal, this is
and you're going to
the
be
general journal,
charging to your credit
another
card, which is
visual.
going to increase
This is,
the amount that you owe
notice that there's a
on that
debit
credit
for
card.
cash first, and then
So if you notice, if
credit
you
for
want to
owner's
increase
capital, and you know that
liabilities,
it's a credit
it's going to
because
be a
it's
credit,
indented.
which is the reason that I put here.
From the
You
general
increase
journal,
accounts payable
we then
or you
transfer
credit
the journal
for
entries to the
$5,000
ledger accounts,
since this
and
is a
these
liability.
bottom ones are the ledger accounts.
So how do I
This
transfer
is
that?
called
So
posting.
we worked on chapter 1
And
with the
this
tabular
visual
form, and I
clearly show
showed
how
you an
to
example
transfer a
earlier in the
general
lecture on
entry
how to
to the
convert that
ledger.
into the account
Basically,
form.
what you are doing is
And so what we're
separating
going to be doing here is using
the
these T's
transactions
accounts
and
and
posting
have
them
one for each
in
of the accounts that are
appropriate
affected.
account,
In
whether
this
it's
case, it's
cash or
supplies and accounts
liability.
payable.
In this case, it's cash and owner's
And we
capital.
determined that in the supplies account, you're going to increase the
Okay.
account, so you're going to
One
debit.
extra component of the
And remember,
ledger
debit
is
means
a column
left.
for balance.
So you're going to be adding the date
And basically, what
of
you're
the
going to be
transaction
doing is
on
for
the debit
each
side
line
and adding
that you post
$5,000
here in the
on the
ledger,
debit
you're going
side
to find what that balance
or
is.
the left side.
Whether it's adding cash
Okay,
into
now
the account,
when you
put
are
what that
increasing accounts payable,
balance is.
we determined that increasing liabilities is a credit under accounts payable. So we go to the T account that's under accounts payable, and the credit is on the right side. So we write that transaction date for April 1st for $5,000 on the right side or the credit side.
From this visual,
and that's all you do.
What we learned in chapter 1.
Now, the next transaction says on April 30th, Renato made a payment for $3,000 for the supplies charged on account earlier in the month. So now this means that at the end of the month, Renato decides to make sure that he wants to submit a payment to his credit card balance so it could be decreased.
In an advertisement company
so
called Pioneer Advertising.
It's going to be affecting our accounts payable account and our cash account. It's going to affect cash because we're going to be paying this credit card with cash money.
Two accounts are affected. Remember, we need to affect at least two
let's look at accounts payable. Accounts payable is part of a liability, and we're going to decrease the amount, right? We want to make sure that the balance goes from $5,000 to $2,000 because we're going to make a $3,000 payment. And in order for us to decrease the amount under liabilities, you have to debit.
The accounting equation, remember, was cash
right?
under assets
under the liabilities.
Under owner's equity.
And debit is on the left side of the equation,
now the next
or the left side of the T account.
To complete the debit.
So we're going to record that on the debit side on April 30th. for $3,000.
Once that is determined, you journalize the transaction.
And that's the reason I put decrease accounts payable as a debit, since this is a liability.
You will post it in the ledger with
now, we also have to decrease our cash account because we're taking money out of our cash account in order to pay this credit card statement.
This whole entire chapter.
And you know that cash is an asset. So if you look at the asset side and you know you have to decrease the account statement, then that tells us you have to do a credit under the account under the cash account.
Records all of the transactions.
So we're going to go over here and we're going to record that as April 30th for $3,000 on the right side.
You took out money
in order to decrease it as a credit.
Here, except you record the
now notice here that there's a statement here that says on April 1st there's a balance for $10,000. Remember that when you open up a business, usually you invest money in cash, so there's usually a cash balance on your cash account
for $5,000.
Perhaps there was none, so this balance could actually be a zero if there was $0 in the account. But in this example, it shows that the balance on April 1st was $10,000, and they put it in as a debit because if you look at the asset side, in order to increase the account, you do it as a debit.
And then on April 30th,
so you'll see this from time to time where you see a balance by $3,000 on an account, and that's just the beginning balance before you actually start making your own transactions based on the directions on the assignment.
Credit
and then on April 30th, you credited
and that's
the cash account for $3,000.
You continue that with the journal. Every time that there's a transaction,
and that's all you do. And if you notice, on each of these T accounts, there's a balance. And
now this
the balance either lands on the debit or in the credit side. And I explained to you earlier that when the debits
pretend that you would like to know
are greater than the credits, then you have a debit balance.
You want to know
in this case, we only have supplies for $5,000. There's nothing really on the credit side, so our balance is going to be on our debit side because the debits are greater than the credits
within the accounting
and the balance is going to be $5,000.
So you're going to separate
now here
the stuff that you have here in the
we have transactions both on the debit and the credit side.
You're going to have your supplies accounts,
and you see that the credits exceed the amount of the debit. When the credits increase are greater than the amounts of the debits, we have a credit balance, which is the reason why we have a balance on April 30th
Along
for
with
2,000.
this information, you have to have
and the way we end up with 2,000 is, remember, we charged $5,000 in supplies, then we made a payment for $3,000, so our new balance is going to be 2,000.
Supplies on your credit card.
And the same thing for cash. We started with a balance of 10,000
on April 1st.
Then we took out $3,000 in the cash account to make the payment for the credit card.
So you debited
as a credit,
$3,000, so now your
and
new
if you
balance
see
on the
that
account is
debits
$2,000.
are greater
And this is
than
what
the
2,000
credits, so we're
represents.
going to have a debit balance, and in this case is 12,000. And the way we came up with that is 10,000 that we started.
So how do you know
we took
if
out
you
3,000,
everything correctly?
we end up with 12,000.
One way to check
this is the first part of what you will need to know for your homework assignment.
Balance looks like.
Now the next, you'll see in your homework assignment that you need to be journalizing
with the balances.
So based on these steps that we took here, we're going to journalize. And remember that a journal is where you record every single transaction in one place and in chronological order.
Your cash is $7,000.
We bought supplies for $5,000.
Your trial balance.
And remember, supplies is an asset.
So basically,
and in order to increase assets, it's a debit.
The balances,
and remember that when you journalize, you always debit first and you credit second.
If there's
the debit is not indented, and the credit is indented.
Is when the total.
And what I mean by indented is that it's shifted a little bit to the right. See how there's a space here.
The total debit amounts exceed the credits. And
so when you journalize, you're going to journalize the transaction. And you're going to write down the two accounts that are affected by the transaction.
So
in this case, it's on April 1st, you bought supplies for $5,000, and you paid with it on account, or you use the accounts payable account because you paid it with a credit card. So you're going to debit the supplies account for $5,000, and you're going to credit the account for $5,000. And then you add in parentheses a little description as to why you did that transaction, and in this case, is to buy supplies on account.
And there will be instances where the
second transaction is you made a payment for $3,000
will equal, but it
in
will
cash,
still be
right?
Incorrect. This may
so on April 30th, you're going to debit the accounts payable for $3,000, and then you're going to credit the cash account for $3,000.
Or when a journal entry is
and then you add a little blurb in parentheses to describe why that transaction was made. In this case, to pay charges on account. And you continue doing that depending on the number of transactions that you need to journalize. Once you finish with the journal, and remember, a journal is like your credit card statement where everything that happened throughout the month, you record it there in chronological order. But then now you want to separate it based on each account, right? So that's where the general ledger comes in. You're going to take all of these transactions and separate them and lump all the supplies transactions together, and then all the accounts payable transactions in another category. So here we're going to have the supplies account, the accounts payable account, and the cash account. For supplies, if you notice in all of these on this general journal, there's only one transaction that's related to supplies, which is the first one. I don't see another supplies account after that. That's the reason why in the supplies account here for the general ledger, there's only one transaction. That happened on April 1st. That was to buy supplies, and it was done by debiting $5,000. And then you're going to record the balance for $5,000 for that line. And then since there's nothing else to really apply here, you bring down the balance at the bottom, which is $5,000. Now you go for accounts payable. And you go back here. And you see that accounts payable is actually affecting two transactions. One here, which is a credit for $5,000. And another one here, which is a debit for $3,000. And they're on two separate dates, April 1st and April 30th. You're going to take those two transactions and record them under the accounts payable area. So on April 1st, you charge supplies on the accounts payable account for a credit of $5,000, and the balance was $5,000. And on April 30th, you made a payment on that account for $3,000 as a debit, so your new balance is going to be $2,000. How did I come up with that? Well, when you bought supplies and you charged them on account, your balance was $5,000, but then you made a payment for $3,000 as a debit, so now your new credit card balance is $2,000. And those are the only two transactions that affect that account, so you are done with this account and you bring down the balance as $2,000 at the bottom. Lastly, you do the same thing for cash. Cash, you see here that it was made, there was a payment here for $3,000 as a credit. Okay? And we also had a balance. Remember we had that balance here? We began with $10,000. Gotta make sure we put it in there. So this is the reason why we have two things here. We have a balance on April 1st that began as a debit for $10,000. And then on April 30th, we made a payment on accounts payable. So we took out cash as a credit. And our new balance will be $7,000. And since this is it for all the transactions, then you bring down the balance at the bottom. If there were more transactions that were related to supplies or accounts payable or cash, then you would see more transactions in this page as well. Okay? It all depends on the number of accounts that are affected based on your analysis. Now you're going to be checking to see if you're doing everything right by doing a trial balance. And remember, a trial balance is just taking the balances on each of these accounts on the ledger and putting them all under one table for easy viewing and access. We have cash, supplies, and accounts payable. And remember that when the debits are greater than the credits, then you have a debit balance and you put it on the debit side. And when your credits exceed the debits, then you have a credit balance and you put it on the credit side. In this case, our cash balance was $7,000. Whoops, what happened here? Let's go back. In this case, we have what happened here? In supplies, we had a debit balance of $5,000. So we put in a debit debit balance for supplies. Then we had an accounts payable balance for $2,000 on the credit side. So we put accounts payable on the credit side for $2,000. And then lastly, we had a cash a balance of $7,000, and that was as a debit. So we put cash as on the debit side for $7,000. Now, just to make sure that we are balancing this account, I also added owner's capital here. Owner's capital, remember, is the amount that the owner can claim after all the expenses are paid. Okay? And so that is a credit on $10,000. I added this. I know it's not part of any of the discussion that we had before, but if I don't add the owner's capital in here, these two columns are not going to balance. One column on the debit side will be $12,000, and on the credit is $2,000. And then you're going to say, well, it's wrong because it doesn't balance. Well, it does balance because there's other things that are going on with these transactions. But in order for me to just be simple about it and straightforward to explain the homework assignment, I didn't include everything, all the transactions. Remember in chapter 1, you did more transactions than just 3 when you completed the tabular form. So I added this for just simplicity to make sure that my trial balance is balanced to show you that process. So once you finish posting all of your trial balance accounts, your accounts balances on your trial balance, then you're going to be adding the debit column and the credit column. And you have to make sure that the debit column equals the credit column, which in this case is $12,000. And that is all that you have to do. So now let me take you to the homework page, the Blackboard page, so I can show you what you are expected to do for this week's assignments. Under week 4, you're going to see that you're going to have your chapter reading, you're going to have your PowerPoint, and then you're going to have your lectures. This time I split the lectures in 3, partly because, I was interrupted in the first part. And in the second part, I just kind of left it off with the lecture. The third part, which is how to complete the homework assignments. And I might be doing that for the future lectures. I might be splitting up the lectures based on concepts. Maybe one of them should be the review for the week before. Or perhaps, reviewing the answers to the homework assignments. Then the second part, I'm probably going to do the lecture part. And then the third component will be how to do the homework for the current week. Let me know if that works out better than just having one lump lecture that you have to listen through all the way to the end. And then you're going to have your lecture assignment. So all you're going to do, again, is just click on the link. It's going to take you to the Wiley Plus page. And you're going to see that you have 10 multiple choice questions. And that's based on your readings and the lecture. And again, this is just to assure that you are reading the assignments. You have one attempt to do these, so make sure that you are answering them correctly, as you only get one chance to get it correct. Then you're also going to have your homework assignment for chapter 2. And your homework assignment for chapter 2 is basically what we just covered right now in the lecture. It's only one homework problem, but the homework problem has 3 parts. It's going to give you all of these transactions, which are similar to what you did in chapter 1 for the tabular form, except you're not going to be recording them in the tabular form. You're going to be recording them as journals. So you have to determine which 2 accounts are affected and which one's a debit and which one's a credit, and you have to record it accordingly. Remember that each of you have the same problem but the different numbers. And I do that on purpose so that you do not copy each other in one form or another, okay? It's for you to be doing your own work. Now let me go over the second part right here, which may throw you off. And the reason Wiley does this is because you also, as an accountant, need to determine when a transaction needs to be recorded or not, when an event needs to be recorded or not. Remember, we have the monetary assumption that we only record stuff that pertains to money. The second transaction here that is asking you to do is on April 1st, this person hired a secretary or a receptionist at a salary of $700 per week, payable monthly. And if you notice here, this says no entry. The reason it's no entry is because when you hire someone, it doesn't necessarily mean that there's money affected by that on that particular day. Just because you hire someone doesn't mean you're going to pay them that same day. Usually you're going to pay them maybe by the following week or in 2 weeks, or sometimes you even get paid monthly. Here you hired a secretary and you determined that you're going to pay them $700 a week, payable monthly. That's it. You didn't pay them that day. Nothing happened. There's no exchange of money. That's the reason when you run across transactions like that and you know that they have no monetary value, you know that they're not supposed to be recorded, you're going to be recording that as a no entry. A no entry for the debit, a no entry for the credit, and you put 00. That is just a way of us checking that you are paying attention and that you're not just journalizing for the sake of just journalizing, because you have to make sure that you review that some of the transactions cannot be recorded because they do not involve money transferring from one place to another. And you're going to be continuing to do that for each of these transactions here. You're going to be journalizing them. Once you do that, it's going to take you to part B. And notice it says the parts of this question must be completed in order. This part will be available when a student completes the part above. If you don't do this part completely, you can't move on. It's going to take you to this. And this part, it says you have to post everything that you had in the general journal. Now you have to post it to the ledger. Remember, posting to the ledger is separating each of the transactions based on each account. So you're going to have all the transactions that are pertaining to cash in one area. All you're going to do is look for them and transfer them either as a debit or a credit, depending on how they were recorded. Like, for example, April 11 was cash as a debit, but on April 30th, there was a cash as a credit. You make sure that you journalize every single one in chronological order as a debit or credit and find the balance. And you do the same for the rest, for accounts receivable, for supplies, for accounts payable, and so on. And again, it's not going to let you go on to the next part until you finish this. And it's going to take you to part C, which is asking you to do a trial balance, which all you do is take the balances of each of the accounts and post them either as a debit or credit. Then you find the balance on each of the columns and you make sure that they balance by having the same amount. And that's it for your homework assignment. Then you're going to have a quiz. The quiz is not timed, and it's going to be based on 3 homework problems, on 3, they're called do-it or reviews, and it's going to ask you some similar questions. It's going to ask you what form should all of these activities be recorded. They're going to ask you to prepare entries in the general journal. And that's it for that homework, for that quiz problem. The other quiz problem is going to ask you to post some stuff on the T accounts. And the last problem is going to ask you for the trial balance based on these accounts here. Notice that you have, for the lecture assignment, you only have 1 attempt. So you need to make sure you do it right. It says right here, this is limited up to 1 attempt. But for the homework assignments, I think I made it for 3 attempts. You have 3 attempts to get it right. Okay? And it's not timed. And I think I did the same thing for the quiz. Let me just check that. For the quiz, I did it up to 3 times again, and it's not timed. So you have plenty of chances to get this right. This time, there's nothing for you to turn in electronically. Everything's going to be done through Wiley, so it's going to be automated. Okay? If you have any questions, let me know, and good luck to you this week.